But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
Why do central banks hold it?
Well, it's a form of reserves.
Why don't they hold diamonds?
Well, it's tradition, long-term tradition.
Well, some people still think it's money.
Happy New Year, Merry Christmas, Happy Holidays. Welcome back here to the Junius Maltby channel. Every year we get together about this time, do an outlook, forecast, peruse some articles, and look at what the predictions might be and what the environment and weather looks like for precious metals, specifically gold. Of course, we're going to touch on silver slightly as the little brother to the big yellow metal. Silver will likely ride on its coattails as well as even perform on its own merit going into this year 2020. It's strange even saying that, 2020. And here we are, the year 2020. Let's take a look at what gold did today. And then I compiled a lot of different articles. I actually started working on this video yesterday, just did not have time to get to it and finish it. But we've got a tremendous amount of information to peruse. So that's why it's going to be likely a long video with one overall theme. If you want to summarize it and not even stick around for the whole thing, I encourage you to do so because there is some data and facts here and some good reading material and stuff we're going to cover. But overall, it's bullish. Metals are extremely bullish right now. And I don't like myself predicting any numbers. I don't do that. I'll never give you a number and I say, oh, this is what it's going to be and this is what it's going to be here. You know, you'll see these strange numbers sometimes people come up with as predictions or bizarre percentage point gains. I'm not going to do that. I'm not going to say 6.8% or 10.3% or, you know, we're going to see 1647 or 1680. All I'm going to say is after reading all this information, looking at what's going on in the world, looking at current performance, past performance, my knowledge of precious metals over the course of time and history and the economy, I'm going to say that they're going to go up. Now, how high? Well, that's what we're going to read here. We're going to take a look at that. You'll see everything from $1,600 to $2,000 an ounce for gold or higher. Of course, there's always those outlying events that could blow it past that and impress all of us. Silver, well, again, what could it do? It's already over 18. We're coming into this year at 18. I think it's going to continue to perform well. I think silver could easily breach the $20, $25 range and even go higher than that. So let's take a look here and see what the so-called experts have to say, the banking and financial institutes. They all have their opinions on here, and we'll read through that. But again, let's take a look at today's performance, today's gold price. So coming into this year, we saw the U.S. Embassy under siege in Baghdad. We're seeing all kinds of geopolitical risk. We're seeing talk of inflation, among other things, the ongoing trade debacle with China. And here we see gold at $1,530.50, well above that $1,500 mark. Again, it's up $2.40 today, up 0.157%. And you can see that chart there. That's a one-year chart. So this dates back to January of last year. This is the whole course of the year. And you can really see, as we've discussed here in past videos that we put out this year, that that June mark, you look at that June and July, just that summer, June, July, August, when gold just really ratcheted up in price. I mean, blowing from 1,300 all the way up to that 1,550 range, kind of settling out there. Some would call that almost like a bull flag, some consolidation, if you will. But we see it now, really stable at that 1,500 range. It did dip below, back down about 1450 there briefly, but here we are back above 1500 at 1530, and that's a good. I think that's a good psychological barrier for gold, or psychological floor, whatever you want to call it. That 1500. When it sits above that, I think we're going to see it take off from here. And again, as I've discussed in the past, when you look at $1,500 gold with the state of the economy and recession risk, the longest ongoing bull market that Wall Street has seen in decades. I mean, just unprecedented growth without any form of correction. And a lot of that, of course, attributed to the bailout activity. Quantitative easing is all fake money, smoke and mirrors. You know, it's like you got that guy, like the Wizard of Oz, sitting over there behind the curtain, just putting on a show and making everyone think that everything's okay and there's all of this growth. And it's magic tricks, smoke and mirrors, and there's nothing really supporting what we're seeing take place there as far as the economy's overall performance. Now you take that away, and once the faith is gone and you see that correction start to take place and you see people running for the exits because the building's on fire, imagine gold's performance at that point, starting in the 1500 range. Because again, you look back at '08, that last financial crisis, we saw gold start off at much lower levels than this. And again, they don't have the safety stops. They're not going to have as many tricks in the bag this time. They've already used them all up. So my guess is the next time this takes off, the next time it happens, the manipulation, the quantitative easing, people are going to know it's not working. And the wealthiest, as we discussed in a video, that was our last video, about the elites and the wealthy moving towards gold, which we're continuing to see a theme here. Central banks buying gold, hoarding it like never before, as well as the wealthy elite. That's going to drive gold prices much further in that upward trend, that upward trajectory. So if you're buying metals, you're doing good. If you've got metals, you're doing really good. Let's take a look at silver now. Now, in my opinion, silver always has a more chaotic, nonsensical chart. I don't understand why it does what it does, and its behavior, especially when you look at the consumption of it, the supply diminishing. You look at the mine closures, the overall demand for silver, and you look at the price point of it. I think it's a buy. It's definitely a deal at $18, in my opinion, especially when you look at the all-inclusive costs for mining to get that ounce of silver out of the ground and in that purified state when you're holding a 1-ounce bullion coin or a 10-ounce bar. To get it to that point, what it takes per ounce is you see those numbers all over the place. Again, I've read them as far as $8, $9 all the way up to $14. So I never really know, depending on the country, what that exact average cost is to extract and purify and have physical silver above ground. But you see it here, 1806, so we're above that psychological 18 mark again, and it only went up about a penny and a half today, up 0.08%. Not a lot, not a big movement day for silver, but we're sitting again above that 18 mark. You look at that year chart, that's a 1-year chart for silver there. Spent, again, most of the year under 15, or a lot of it under 15, averaging around that 15. You know, it touched on 16 back in the spring, and then it dipped right before June. It hit that low, and we were under the 15 mark again. And then it kind of picked up, just following gold or maybe doing it on its own, but we saw it breach all the way up to that 19 plus mark, and then again kind of drop back down and then hang out anywhere between that 1650, 1670 range, bouncing up back into 18 just recently, coming back from the 17s. So again, silver starting the year 2020 off at $18.06. Could it correct from here? Definitely. It could easily retreat back to 16 again and bounce back up from there. But I do believe silver will follow gold, and we're going to see it perform quite well in the year 2020. Will it go back to 15 or below? I don't think so. But then again, silver always does things that I don't think it's going to do. It's sometimes a little bit more volatility in that metal, and just seems to kind of behave on its own, sometimes in opposite directions of gold, and not really follow suit with what one would think it should do, especially when you look at sometimes performance of gold, and you'll look at silver. I mean, why is silver lagging? Why isn't it catching up? What is it doing? You know, again, there's a lot of manipulation there with the silver market. We've covered that, the spoofing, the JP Morgan. You know, there's guys that supposedly have been sent to prison for manipulation of the silver market. Now, hopefully that stops. And if that behavior ceases, It might unshackle silver to be able to perform and behave in a little bit more of a free market sense. However, I wouldn't place any bets or sit there waiting for that to occur. I think there's always going to be some type of mainstream, Wall Street type manipulation from the mainstream financial institutions, the big banks that are able to buy this stuff, dump this stuff, and just do backdoor, behind closed doors, shady-like activity when it comes to the precious metals world. All right, there we got the price of gold could hit a new record high in 2020. That's from Barron's. A couple of headlines here. These are out today. Gold rises back towards a 3-month high. Markets eye Fed minutes. Spot gold up 0.4%, 1523. This was, again, earlier in the day, about 18 hours ago. Precious metals, this is from Reuters. Gold rises back towards 3-month high. Markets eye Fed minutes. That's another 13-hour-old article. Gold prices could climb to another record high in 2020 by Simon Constable. This is from today, January 2nd, 2020. Investors who didn't own gold in 2019 could be kicking themselves after an 18% rise in prices for the year. Think of that, 18%. Like I always say, when you look at these big percentage gains on a year for gold, if it was any stock or any other investment vehicle or asset, you would see people just applauding it. You'd see headlines talking about it, bigger headlines than this. It'd be front page news for a lot of people. It gets ignored. People really don't look at the performance of gold and talk about it much outside of these circles. But it might not be too late to join the rally. Some gold bulls even see the price of bullion breaking the record high set in 2011. So look at this prediction. When it briefly topped 1900. So there's some thinking it could top that. Roughly 25% higher than current levels. Robust buying by central banks, a weakening of the U.S. dollar, and growing political tensions could combine to fuel further gains. This is absolutely a scenario that could play out and we could see. I mean, we just saw 18% on a year. 25% for gold really is nothing. Easily achievable, easily obtainable. This is truly a possibility, and it could take place this year. If we think about it in percentage terms, to imagine gold making a new all-time high sometime in 2020 doesn't seem like such a stretch, says John Roque, a technical analyst with Wolf Research in New York City. Roque and his colleagues see a repeat of historical chart patterns in bullion prices playing out. Quote, we believe gold, A, will break out above resistance at 1557, B, work to 1650, and then C, make a new all-time high, says a recent Wolf Research report. An ounce of gold recently fetched $1,515 an ounce, according to the London Bullion Market Association trade group. Well, today they're fetching a little bit more than that, again, as we saw earlier, at $1,530. Other investment firms see higher prices. Swiss bank UBS has a base case scenario of $1,600. New York-based commodities consulting company CPM Group and asset management company State Street Global Advisors see potential highs of $1,600 and $1,650. Investors looking to capitalize on the likely continued rally should consider buying the SPDR Gold shares, Exchange Traded Fund. I love how they always throw these in there, the paper gold fiends. It's just ridiculous. Instead of encouraging people to go out and get actual physical bullion, get that stuff off the market so these guys can't manipulate it. Do not get paper gold, please, ladies and gentlemen of the Junius Maltby community. Get physical. If you don't hold it, you don't own it. So again, the GLD, which holds bars of solid bullion. Alternatively, try purchasing active month gold futures contracts on the CME. No, don't do that. A big part of the bull's case is that buying by central banks will continue to absorb a lot of the metal. Collectively, central banks have purchased an average of more than 500 metric tons of the metal each year from 2011 through 2018, according to World Gold Council data. Initial data suggests a similar pace for 2019. Better still, the trend looks set to continue in 2020, says George Milling Stanley, chief gold strategist at State Street. Central banks, quote, feel they are seriously overweight in dollar assets, unquote, he says. Watch gold in 2020, says one of Wall Street's most influential stock market investors, Blackstone's Byron Wien, says gold, quote, has a chance to be an interesting investment, unquote. Now, you know me, I don't like to call gold an investment. You know what? I don't even like calling it a hedge. It's just gold. I don't really think it falls into any particular category for me. It's just gold. It's real money. Everything else is just credit. It is wealth. And holding it is, well, dynastic wealth retention over the course of time. It's a way to preserve one's wealth and maintain it and truly hold it. Again, I get sidetracked, but let's, you guys know that viewpoint of mine. Let's continue here. That is how the veteran investor, whom U.S. News and World Report described as a modern-day cult figure on Wall Street and one of the most influential investors, described the outlook for the yellow metal in the coming 12-month stretch during a CNBC interview ahead of the release of his well-read list of market surprises. Wien didn't provide further clarity on his gold estimates or the precise direction of gold trading in 2020. So he didn't really, again, point to any particular trajectory or price. He just said it'd be interesting. I think we all know what that means. I don't think this guy's an idiot when it comes to seeing what's going on, especially if he's as renowned as they say he is. However, again, we'll have to see. I'd like to hear more from him on what he believes and why gold should perform in an interesting fashion. I think that's an interesting word to use. Interesting. Very interesting. Gold has gained 17.3% so far this year based on the most active contract according to FactSet data. Now, this is an older article, dated by a couple of days when it came around the new year. I believe the 18% that we talked about earlier is more accurate. That is a relatively healthy run-up for the metal, considering that stocks, which tend to move in the opposite direction of gold, have been trading near all-time highs. So again, this big percentage gold we saw in gold, the percentage gain, it took place with extreme stock market growth. So think of that for a minute. It rose even though the stocks were doing the same. And it's most likely going to continue rising, especially with more velocity, if we see a stock market retreat. And that recession-like activity that some people have been discussing is right around the corner. We've seen things like the housing market show signs of that. We've seen the overnight lending rate, the whole repo market situation. There's definitely some tremors taking place that indicate recession-like activity in the next coming year or so. If that's the case, I would think gold would then shine even brighter than it has. So if it did 18% with good stock market growth, that 25% we talked about that to reach that record high is easily achievable. Now look at this little gem of data that was snuck into one of these articles. I like pieces of information like this, and I think some of you value it as well. This is showing gold's average monthly percentage change over a span of years, how it performed on average for any given month. And if you read up top there, it says the best month for gold is August, when the precious metal averages a gain of about 1.57%. You can see January there averages about 1.53%. We see a couple decline months there in February and March, anywhere from 0.43 to 0.70% down. And then April, we see it pick up 0.41, and then May and June, really stagnant. I mean, those are really negligible numbers, 0.08 and 0.05 as far as declines, and then a 0.25% gain in July, and then August, 1.57, September, 1.27, October, we'll see a 0.7 retreat. These are averages. November, again, a 1.04% gain, and then December kind of flat, but the monthly average is around 0.34%. Now, this is just averages for these months, and there's a lot of different discussions on why certain months perform a certain way as opposed to others. Again, if you read the bottom here, January, however, tends to be a strong period of gold buying, with Asian investors usually taking a shine to the commodity around Lunar New Year, when gold is offered as a gift. Now here's a bold call. Gold prices to hit $2,000 in 2020. City Index. This is from Niels Christensen. And again, this article was from December 30th, 2019. You can see it right there. Bond yields are likely to remain depressed as global central banks try to combat slowing economic growth and subdued inflationary pressures with extraordinary loose monetary policy, he said. However, the spark that could kick the gold rally into a higher gear is a correction in equity markets. We just discussed that. Gold has managed to push back above $1,500 an ounce as equity markets have pushed to new record levels. Many analysts have raised concerns about a correction in the equity market, which continues its longest bull run in history. So, a reminder to what we discussed earlier and in past videos. Gold has performed very well with growing equity markets. Now imagine the retreat on Wall Street and how gold will perform with that as a backdrop. If U.S. stocks were to correct themselves in 2020, then this surely could lead to elevated levels of safe haven demand for gold, said Raza Kazada. As the U.S. equity market bubble finally bursts, safe haven demand could nudge gold past its 2011 peak of $1,920 an ounce before tagging the $2,000 psychological hurdle. And here's my opinion on that, the 2,000 mark. If it breaches 2,000, I think, and I don't like to use this term, it's kind of an internet term with investing and the crypto world, but FOMO, fear of missing out. I really think FOMO would hit gold pretty hard if it breached the 2,000. I think some people would actually buy it purely because it's that mark. It breached that. I know that sounds crazy to some of you, especially if you've been stacking for a long time. Some of you, veteran investors in gold, veteran buyers, veteran gold stackers, gold hawks. You were buying back at 256 during Brown's down in 1999, myself included. Now to see it at 2,000, that's a pretty big leap from where we began. However, there is something psychological about that. A lot of things that play into that. There are some wealthy that won't buy a particular item at a certain price. But if you raise the price on a particular item, now this isn't just pertaining to assets and investment vehicles, just even in luxury goods. If you raise the price to a higher level, they'll buy it just because it's more expensive. And they like to exercise that luxury of having wealth and buying things that are more expensive. It's just the way it is with some of those people. Even you have two watches side by side that are identical. One's $300. The other one's $3,000. You'll have wealthy individuals that will buy the $3,000 watch, no questions asked, strictly because of the higher price tag on it. It's a psychological thing that they do. Now, will that play into gold? I can't tell you it will or it won't. But I can tell you that if it breaches 2,000, I think we're going to see it accelerate beyond that, and it's not going to stop there. I think if it breaches 2,000, the next mark is 2,500, no problem. Compared to the 18% we saw last year and these calls of 25% are reaching new record highs, this is a pretty conservative estimate, I would say. This rising inflation risks could push gold prices 10% higher in 2020. This is from Invesco Outlook 2020. Again, this is an article from Niels Christensen. So 10%, not really a big deal if you compare it to past performance for gold, which, what does it average? Typically about 8.5%, 9%, somewhere in there. I think that's the average yearly gain. If you look at a span of the last 2 decades, I believe it's about 8% on average. We are starting to hear concerns about commodity prices rising, she said. Central banks have set a really high bar for inflation, and I think that is going to be good for gold. In the current environment, Hooper said that she could see gold prices well above $1,600 by the end of 2020, representing a gain of 10% from current prices. Higher inflation pressures are positive for gold because it pushes down real bond yields. Gold's opportunity costs as a non-yielding asset improves in a low to negative interest rate environment. Hooper added that because of the Federal Reserve's 3 rate cuts in 2019, it wouldn't take a lot of inflation to push real bond yields in negative territory. And remember, we have a president that was calling for negative interest rates. Remember that. Trump was calling for that. And that's a scenario that could definitely unfold. We could see interest rates being cut further by the Fed. And will we see negative? I can't tell you that it will happen or it won't. However, I think that we will definitely see a continuation of quantitative easing, which in my opinion is not only is that inflationary, but it definitely adds to the case for gold. U.S. Treasury data shows that real yields on 10-year bonds are preparing to end the year at the bottom of its recent trading range at 50 basis points. Real bond yields have fallen more than 50% since the start of the year, even as inflation pressures have been muted. Central banks have made it very clear they are going to be tolerant of higher inflation, she said. The Federal Reserve has set the inflation bar pretty high, and I think it will only get higher next year as we see a dovish shift on the board. I warned you guys this was going to be a long video, but it's good stuff, isn't it? Money printing and physical demand will drive gold higher. This is from Dave Kranzler. I'm growing more confident that we're on the cusp of a big move higher in the precious metals sector because of the Fed's massive money printing. Also because the money printing and near zero interest rates are visibly not stimulating economic growth. We're at the point at which, unless the Fed continues increasing the amount of money it puts into the system, the melt-up in the stock market is completely unsustainable. This is very similar to late 1999 or early 2000. Again, gold was what, 256 then? When Alan Greenspan tried to reverse his Fed's massive money printing operation ahead of that notorious boogeyman, the Y2K bug. Not only did the tech stocks collapse then, but also the precious metals sector transitioned from the end of a 19-year bear market into the current secular bull market. From what I'm hearing, and something that's been referenced by Alasdair MacLeod and Egon van Graerts, a shortage of physical, deliverable gold is developing in London. This is pretty big news here if this is true. A shortage in physical deliverable from London. The action this past week fits the information. Given the size of the derivative short position, futures, LBMA, forwards, leased gold, OTC derivatives, hypothecated gold, in London and New York, if obligated counterparties begin to default on delivery demands, the precious metals sector could become explosive next year. The paper gold open interest continues to hit new all-time highs almost on a daily basis. The current open interest in 765,000 contracts, that's 76 million ounces of paper gold. The quantity is a little less than double the average open interest on the COMEX over the last 10 years. The amount of open interest has nearly doubled since the end of 2018, with record levels almost every day since October 29th. Never in the recent history, last 20 years, has the COMEX sustained this many open interest hit record highs without being followed by a significant price break takedown. Hidden factors seem to be preventing this, as evidenced by the inability of the COMEX banks to implement a run-of-the-mill open interest liquidation price attack operation. These used to be good for over $100 of downside in a short period. The COMEX gold vaults reportedly hold 8.6 million ounces of gold. That figure has remained fairly constant, with perhaps 10% variability up or down for at least the last 10 years. If just 10% of the open interest stands for delivery in any given month, there would be a short squeeze of biblical proportions in the price of gold. Notwithstanding that, the soaring open interest in paper gold in relation to the amount of underlying physical gold on the COMEX is evidence of the degree of effort required for the banks to at least regulate the rate at which the gold price is rising. Circling back to rumors of a growing shortage of physical gold in London, see the analysis, for instance, from the Gold Antitrust Action Committee GATA, it's interesting to note that every attempt to push down the price of gold when the LBMA and COMEX trading floors are open is quickly repudiated. Gold may be on the cusp of a big upward price reset. It just looks like headline after headline after headline pointing to a bull market. I tried to look for it, and I actually couldn't find a bearish view for gold in 2020. And I don't think that's even happened before. coming into a year where I saw no bearish articles discussing gold. I'm sure there's one somewhere out there. Some idiot wrote one, but I haven't seen one yet. Precious metals investors may be getting an unexpected Christmas present this year. Again, this is a little earlier article. Remember, I told you I pulled these from a span of the last week or two. So some of these predate the new year that we're in right now. Beginning with the sudden $25 jump in gold on Tuesday and Wednesday, from what I'm hearing, a shortage of physically deliverable gold is developing in London. In fact, Alasdair MacLeod and Egon van Gertz have both alluded to this development. So again, pay attention to that. If there is truly a physical shortage developing in London, we're going to see some more price action going forward. The action this past week fits the information given the size of the derivative short position. And this is a reiteration of what we discussed just earlier in the last article. Futures, LBMA forwards, lease gold, OTC derivatives, hypothecated gold in London and New York. If obligated counterparties begin to default on delivery demands, the precious metal sector could become explosive next year. Central banks are not dummies, and here you see central bank gold hoarding hits a 50-year high. While dozens of the world's economic leaders participate in extreme monetary easing policy, central banks have also been hoarding gold. Central banks accumulated over 668 tons in gold purchases this year. Excuse me, kitty. The kitty's angry. He wants to eat. I need to get back to my thoughts here. Central banks accumulated over 668 tons in gold purchases this year, which is more than 2018's record numbers. In fact, the key drivers in gold demand this year stemmed from central bank purchases, most of which were bought 390 tons during the first 2 quarters of 2019. Kitty. Little kitties. Wow, most of which were about 390 tons during the first 2 quarters of 2019. Taking a look at this chart here, this is central bank gold buying set for a new high in 2019. You can see the white bar there, the graph of the gold spot price, and that's the average. And then you can see the in the gold, big gold bars there, that is the actual central bank gold net purchases. Okay, that's the net purchases for the central banks, and it has been definitely growing since 2010. It really exploded there in 2013, and then again, look at this in 2019. Incredible amount of activity taking place as far as central banks purchasing the yellow metal. In 2018, gold touched a 50-year record as far as central bank demand for the precious metal is concerned. Data shows that 2019's gold purchases are up 17 tons more than the 651.5 metric tons purchased the previous year. Some of the biggest central bank gold purchases this year came from places like Kazakhstan, Russia, and Turkey. A variety of newer gold buyers also appeared in 2019, surprising a few economists. For example, in February, the Reserve Bank of India increased buying by 40 tons, and the country hadn't increased in over a decade. And I also often have referred to the large India purchase back in around, 2010, 2009? They made a large purchase back then, again, a decade ago. Poland increased gold purchases as well, seeing a 25% rise year over year with an increase of 25 tons. In 2019, Hungary bought more gold than it has in the last 30 years. A number of market observers have different opinions on why the world's central banks are stockpiling gold reserves. Investment analyst Sebastian Sienkiewicz believes it's because gold is a reliable safe haven asset. And he believes that's the reason. I think it's one of the reasons, but I think they also see what might be coming right around the corner. Private and domestic demand for gold rises, while Germany drops limit to buy gold anonymously. Independent commodity and former Macquarie Group analyst Matthew Turner explained on December 2nd in a private note to investors that despite slowing numbers toward the end of the year, 2019's gold demand was invoked by central banks. Turner noted that China and Russia reduced their purchases slightly, which did impact data to a degree. The analyst said that countries like Russia are trying to spur domestic producers to export their gold. Turner also noted an oddity when he explained that China skipped out on purchasing gold during the month of October. The manipulated stock market is partying like it's 1999. In addition to the central bank's current gold hoarding, the U.S. and global stock markets have been in an extreme bubble. On December 26th, market analyst Holger Jaspitz tweeted about NASDAQ hitting a new milestone. Quote, "Party like it's 1999, unquote," said Jaspitz. NASDAQ hits 9,000 for the first time in the year-end rally, now up 36% year-to-date. Bitcoin commentator Gabor Gerbax replied to Jaspitz's tweet and said, "This is the case for Bitcoin and gold in one chart," Gerbax added. That's a good point. I would love to see the NASDAQ retreat that 36%. It'll be hilarious when it does. Central banks and other financial market occultists destroyed honest markets and valuations. Younger generations are deprived of the opportunity to participate at a reasonable price. Sandcastles cannot hold up forever. Now let's take a look at that NASDAQ chart. This is the NASDAQ Composite Index. It hit 9,000 for the first time in 2019, and some skeptics believe the stock market bubble is destined to burst. And there you have it. Just take a look at it there. You see that big pop there in 1999? We saw it retreat from that quite heavily. And look at this unprecedented meteoric rise in the NASDAQ Composite Index. Definitely due for a major correction. And remember, look at that 2010 to 2019. Throughout that course of time, gold has also performed. And we see gold over this last year, again, up 18%. When you see that NASDAQ dip, I expect that to propel gold a little bit further. Commoners are not privy to the reasons why central banks are hoarding gold, but a number of individuals think it might be because the current stock market rally will end badly and soon. Last year, the World Gold Council explained why the central bank gold purchasing continues to surpass the highest volume on record. The report highlights the biggest reasons why central banks stockpile gold is because of, quote, gold's role as a safe haven asset and an effective portfolio diversifier, unquote. And here's a tweet from Electronium Belgium. "If I look where the smart money went this year, I see gold. Even central banks bought more than ever before, over 550 tons. Central banks know what is coming. Only thing with gold is that it is difficult to spend it for payments." And the only reason for that is because of the government laws in place that try to curb our behavior in a barter economy or using competing forms of units of exchange, competing currencies. They have a monopoly on currency issuance, and Ron Paul has spoken very well on this topic and this issue. And you just have to know where to spend it. Someone will always take your gold. They'll always be willing to barter, trade, and there's always a way to get goods and services for gold. You just have to know where to look. Interestingly, World Gold Council's research also said central banks manage gold the same as other reserves, but it is often excluded from their portfolio optimization. This means while these financial giants hand out lower rates, negative rates, and encourage borrowing, they are betting on gold against all the risks they created. The shell game will soon be up, and the general public may realize the central planners' band-aids are severely depleted. 5 key reasons why gold's price is set to skyrocket in 2020. 2019 has been a great year for the gold price, but the yellow metals rally is far from over, and here are 5 reasons why. Gold price looks set to break a key psychological resistance. Round numbers tend to act as support and resistance for stocks and commodities alike. The 1500 to 1550 area is a long-term resistance, and gold price peaked at roughly 1557 in 2019. A decisive breakout above this level can send prices soaring, and we're very close already, ladies and gentlemen. We hit 1530 today. We've got concerns about the U.S.-China trade deal. Trade war tensions between the U.S. and China have been a primary driver of gold's price this year. The yellow metal is expected to tumble if the trade war ever comes to an end. I disagree with that sentiment. When President Trump announced a Phase 1 trade deal with China, gold prices stayed flat. It seems like the broader markets have realized that a trade deal will not be signed. The weakening U.S. economy is a tailwind. The U.S. economy is at best standing on flimsy grounds. The manufacturing sector is weakening as durable goods orders sank 2% in November. In addition, consumer spending, which accounts for about 70% of the U.S. economy, is being driven by debt. And there you can see the durable goods orders, that decline there of 2%. And again, we just discussed this. We've seen the U.S. economy is on life support. And we just looked at that NASDAQ chart. We just talked about that. So yes, the U.S. economy is a tailwind, and it, in my opinion, is more than likely going to weaken in the coming 2020 and even going into 2021. Now here's something we've discussed, and it doesn't get a lot of news. I talked about this a few years ago, but the key Islamic nations ditching the dollar. After the Islamic summit concluded in Malaysia last week, Iran, Malaysia, Turkey, and Qatar announced they are exploring trading in gold. This comes in the wake of hefty sanctions by the U.S. on Iran. Fearing future penalties, the Malaysian Prime Minister said, "I have suggested that we revisit the idea of trading using the gold dinar and barter trade among us. We are seriously looking into this, and we hoped that we will be able to find a mechanism to put it into effect." The dollar has been the world's reserve currency since 1944, but the number of countries ditching the dollar is on the rise. Gold, on the other hand, has been the de facto reserve currency for thousands of years. Its demand will only go up if the trend of ditching the dollar continues. This is one of those hidden key motivations, I think, that the West wages war on some of these nations. We saw it with Libya, and we saw a lot of discussion back then, even with Iraq, different deals being made to have a gold-backed dinar, to get away from trading in the dollar, even trading oil for gold and gold for oil, and so on and so forth. There was a lot of discussion there, and I don't think the United States looks very friendly upon such decisions by these nations. They like to force people, and when I say force, I mean violently force people to use their currency. The Federal Reserve note, the leper with the most fingers left, the US dollar. Hoarding is on the rise. Russia is leading the trend in gold hoarding. Russian mining operations have gone up a gear this year. They mined 185 tons of gold from January to July in 2019 compared to 2018. This is an increase of roughly 18%. Consequently, Russia's total gold reserve is up to $548 billion. Quite clearly, Russia seems to be moving away from the US dollar, but it is not alone. Everyone, from the super rich to the central banks, seem to be on a gold buying and hoarding spree. Considering all the technical and fundamental reasons, gold price looks set to skyrocket in the years to come. The most conservative estimate I've found is here. Gold will rise by 6.9% in 2020. Mark Holbert writes that if gold has an average year, just an average year in 2020, gold bullion would be a smart bet, and here's why. And that's a pretty good rise. So think of that. Just a 6.9% rise, and that's considered conservative. That's considered an average. Not bad. Pretty good performance. Gold bullion will gain 6.9% next year, adding approximately $103 to the price of an ounce of the yellow metal. That's assuming gold has just an average year in 2020, and based on various analyses of gold's historical record, that would be a smart bet. Again, we're going to, we see 8%, 10% quite often, 18%, 20%. You look at the record, the different years that have passed behind us, 6.9% is really nothing. And the final article, options trader makes a big bet on gold into 2020. This is from December 31st, just a couple days ago, from Tyler Bailey. Gold is about to end the decade on a high note and will close out this year with its best performance since 2010. Bullion has bounced 19% this year, even as stocks have soared to all-time highs. And he closed the article off basically saying the same thing that we just talked about for the last 45 minutes. Gold being bullish going into the year, being the best bet, a good bet, and lots of growth behind it. So there you have it, ladies and gentlemen, the case for gold, the Gold Outlook 2020. We spent a lot of time talking about it. We just digested quite a bit of material, looking at different charts, and I can't really think of anything that would cause gold to naturally retreat this year. Anything outside of outright and blatant manipulation. So there you go. If you're looking at buying some metal, here we are sitting at January 2nd, 2020. You got 363 days left in this year, and you can make your gold purchases over that course of time. Just remember, everything we just saw is pointing to a price rise of, at minimum, really about $103 an ounce this time next year. Could be a lot more than that. Could be $500, $600 an ounce more this time next year. But we'll have to wait and see. We'll have to check in on this video a year from now. I don't often do that. I should go back and look at some of the Outlook videos and see where gold ended up a full year later. But there you go. I put my work in. Here's the video. Now you know your job. Go down below, fight it out, hash it out in the comments section. Thanks for being here. Thanks for being part of the Junius Maltby channel. As always, I appreciate all of you who support this channel, who help out, and not only send me links and little bits of news or discussion topics you'd like to see, but also those of you who click on some of the donation tabs below, visit my Patreon account, Patreon, however you pronounce it, and help out in that way. It does help keep me motivated, keep the channel going, and keep me here at this desk when I could be out working other jobs and doing what I need to do, doing other things. But I appreciate all of you who support the channel, help out, and motivate me and maintain the community here that has become the Junius Maltby channel. Have a good rest of your evening, and again, Happy New Year. Have a blessed and healthy 2020.